Coming up in today's review, stocks surged to new highs, led by semiconductor stocks, regional banks in trouble, gold rips higher, and another example of the Wall Street hustle. Hey, what's up guys? Welcome back to the Click Capital Daily Market Review. My name's Jared. I hope you're all doing well out there. And a big thanks to everyone who tunes into this show every day. This channel continues to grow by the week. And so if you haven't already, hit that subscribe button as I post these videos every day about 2 hours after market close. And there's a look at your heat map for today. Huge rip up in the semiconductors. They are on absolute fire. Parabolic rally continues in them. A little bit soft in other big tech names, including financials. Energy had a good day along with healthcare. And just switching over to a weekly heat map. See, it was pretty mixed for the week and in a similar look to the heat map of today, with semis right out in front. Bit of a bounce back in Tesla and still some weakness in the defensive sector of utilities. And so we've just completed the first 2 months of the year, and there's a look at the year-to-date performance. Some big divergences in the big mega cap tech stocks. NVDA up an eye-popping 66% year-to-date, while Tesla still down over 18%. Meta's been a real strong performer this year as well, up almost 42%, and a few other stocks underneath the hood not getting much attention. General Electric up 24%. Another strong performer continues to perform well, Eli Lilly, on the back of its obesity drugs. We've got Warren Buffett's Berkshire Hathaway up 14% year to date, and Home Depot up over 10% as well. There's a look at the daily chart. The S&P 500 closing above 5,100 for the first time ever, and this parabolic grinding uptrend continues. Even stronger performance today, the Nasdaq up 1.5%, and we're starting to get a bit more breadth and participation out there. Russell 2000 small caps shaping up here, looking to break out of this resistance zone it's been in for about a year and a half, and we've even got the small end of town micro caps starting to shape up as well. Looking to put in a bearish to bullish chart formation after it too has been going sideways for a year and a half. So it's no surprise volatility pretty much sitting on the ground here at 13, and a bit of a pullback in bond yields today on some weaker than expected manufacturing economic data. However, you could think of the 10-year yield just above 4% here, kind of really in the sweet spot. If we were to go up above 5%, that increased the cost of capital. Risk assets won't like that. And if we were trading below this level here, 370, 360, that'd be the bond market forecasting a substantial amount of weakness. So between 3.7 and 4.7 is kind of a real sweet spot for rates here. And overall portfolios at large as well, with bond prices holding up pretty good now. Even high yield bonds still holding up really well. And there's a look at Bitcoin, just calling up a little bit again today, trading below 63,000 a coin. And we're all watching whether it can break out to new all-time highs over the coming days and weeks. Not good for inflation though, as shipping and cargo rates continuing to rip higher here on the back of continued tensions in the Middle East, along with that weaker economic data, helped gold to have a good day, up almost 2%, almost getting 20, which is just about its all-time record closing high. It has traded higher back in early December up to 21.52, but it's never really closed above 2100 before. And there we go with crude, actually getting above $80 a barrel today, continuing to hold up and remain well bid here. And stick with me, I'll come back to the charts later and show you what else I'm seeing out there. So things are just on fire with semiconductors and AI. We saw that with the former tech darling of the 1990s, DELL Computer, ripping up over 30% today after reporting good earnings. They too are seeing a boom in revenue and profit thanks to the huge capital expenditure, that's capex, of the largest companies in the world on all these chips and servers to power their AI models and apps to process a lot of data. And it's not just NVIDIA ripping, AMD performing even better this week, and the semiconductor sector as a group now up over 16% year to date versus the S&P, which is already having well above seasonal performance year to date itself of 7.1%. Really strong candle there on NVIDIA today, finishing at highs and a record all-time high closing price, now with the market cap above 2 trillion. AMD again surging to close at new all-time highs. There's Taiwan Semi, a huge rip in DELL Technologies today, now with a market cap above 90 billion. However, we've still got Intel lagging a bit behind, trying to hold ground after their earnings gap down. It's not only the chip stocks themselves spilling over to other areas of the market, like in data center REITs, getting a lot of big investment from the biggest real estate investors in the world, as all these servers and chips need to be housed in secure facilities. And we can see that in data center REITs, like Equinix, trading really strong these last couple of months, now richly valued as well, trailing 12-month PE of 86. Also strong performance these last couple of days in another data center REIT, Digital Realty Trust. That still has a good dividend yield of 3.3% as well. And this is really spilling over into mainstream media. We're now getting magazine covers like this from The Economist. how high can markets go, with a ball being lifted by a bunch of balloons, which is a pretty good visualization of this market. Unfortunately, looking back in history, there's a little thing called the magazine cover indicator, and that's been studied for over 100 years. Whenever there's big headlines that we see on mainstream media magazine covers, they often coincide close to major turning points, whether bottoms or tops in the market. And that's because journalists and magazines write about what everyone's talking about, because that's what's going to sell the most amount of copies, get the most amount of clicks. This is a famous one here from 1979, the death of equities. After it was a lost decade in the stock market, that wasn't too far off a secular bull market low. And so the reason why there's a magazine cover indicator is because it's representative of the amount of talk and hype around a certain topic, and that's why it could be nearing a peak. But that's not to say this AI bubble can't continue for even a couple more years. Even these magazine covers don't nail the tops and bottoms down to the month. You can see that here in June 2005, Home Sweet Home. Talking up real estate, that was still a couple of years before we had the great financial crisis. But nonetheless, it's a sign of the times. And in another sign of the times, we're already seeing an uptick in private companies rushing to the market to take advantage of this optimism and cash in. With the latest company planning to go public, social media network Reddit, seeking a valuation $6.5 billion, which in my opinion is just another classic example of the Wall Street hustle. Because even though they're looking to take $6.5 billion from index funds and investors, the company only made $804 million in revenue the last year, of which it lost $91 million. This is a website that's been around for almost 20 years and they still haven't figured out how to make money. Even though most of their staff, their moderators, don't even get paid. So somehow they spend more than $800 million a year in just running what's really a basic website that hasn't really changed in years, just people posting comments. And the Reddit CEO, Steve Huffman, in partnership with the board and Wall Street banks, is cashing in on this big time. And Reddit users, who have a lot of leverage over the company, are already starting a bit of mutiny over there. Even though they've been offered a little bit of stock to the most loyal moderators, that still doesn't look like it's enough to keep them happy about it. And the IPO document's actually listed as a risk that their users could turn against them and gang up against the company. And just looking on Reddit itself, I can see that already happening. With no doubt many users and moderators that have been on there for years haven't been paid a dime. Well, once again, the CEO got himself $193 million last year, stock compensation, salary, and other bonuses, not to mention another $100 million for other members of the board. And so just think about how crazy that is. A company that makes $800 million in revenue is losing money. Over a quarter of its revenue just goes to a couple of guys at the top. And the reason they get away with that is because that favors everybody who's in control. The board of directors, the Wall Street investment banks putting together and brokering the deal, they all get filthy rich offloading this stock onto the market, with investors left holding the bag, hoping one day the company can make a profit. And just looking at this thread, that's why we've got some comments like this. Other ones like there's no passion there for the website. They're all cashing out. Another person say, I'm so exhausted and disgusted by the monetization and over-monetization of every facet of human behavior. I'm honestly wanting to find a different place after it goes live. It hit its peak around 2013. This stupid platform has barely improved its ad offering over 10 years. How did they pay this guy $200 million? So on and so forth. So that's the sentiment coming from some big time users of the site. You could think of it as like their customers. If all these people stop coming on here, then there won't be as many ad impressions to sell, because you could think of it as like an ad business. However, that's why it's the classic Wall Street hustle, because just like we saw with Snowflake, they'll dump shares onto the public, milk the company for all it's worth, and then just resign one day and kick the can down the road for someone else to deal with who will come along and try and do the same thing. And that's exactly what we've seen in Snap as well, which even though the market's absolutely rocketed over the last 7 years, Snap's still trading well below its IPO price, even though management have paid themselves billions of dollars. On top of losing billions of dollars, company's never made a profit. They too will resign, having milked it and moved on. So if there's one lesson to take away from this, for us small investors, is just don't play in their games. Go back to basic economics. Invest in companies that make money. Invest in founder-led companies who keep more of their shares than sell it, who don't pay themselves exorbitant salaries and compensation packages, who truly care about shareholders. And you want to see the best example of that? That's Warren Buffett and his company Berkshire Hathaway. For decades, just paid himself a salary of $100,000 a year. Tried to save the company every dollar it could, and it still does. This is the website of Berkshire Hathaway, which is obviously run on the lowest budget possible. And so for Warren Buffett, he still knows the value of a dollar, and he actually cares about his shareholders. But this everything bubble that looks to be reinflating in version 2.0, allowing these Wall Street hustles, along with all the liquidity from the Fed over the last 15 years, ridiculously low rates for that time as well, in addition to the huge rise of passive index investing, fake currencies pumped up, pictures of rocks. Like this article says here, why we risk a cartoon version of capitalism, I'd say we're almost already there. And just looking at a long-term chart of NASDAQ, there's no telling how high this may go. Same with S&P 500. Can you imagine if we just kept ripping and we hit 10,000 in the next couple of years? That, in addition to some inflation measures, like the prices for personal consumption expenditures actually increasing the most month over month since back in 2022, we very well may get a situation where the Fed can't cut at all this year, which is very troublesome for the US government, as they'd love to refi back down at 2-3% if they could in the coming year or so, as they're adding over $1 trillion to the national debt every 100 days, which is just simply an unsustainable rate. But that, along with the troubles in regional banks, like New York Community Bancorp plunging 25% today, isn't worrying the broader market or financial sector as a whole right now, even though they disclosed more surprise losses, slashing its dividend and setting aside another $500 million to cover loan losses, as the volume of its bad debts on its books has soared through exposure to commercial real estate. However, it is possible the system can swallow up this commercial real estate problem a lot better than 2008. One, for example, commercial real estate market as a whole isn't as big as consumer debt, and the system's learnt a lot from 2008. The Fed's already working with all these banks to get out in front of it, and so they may just spread out the losses and problems from this over a couple of years. It's already been going on for over a year, so maybe it isn't a problem, and the market's already figured that out and just doesn't care about it at all, even if we see a couple more of these regional banks go under. Market doesn't care about tensions in the Middle East and how it's getting oil prices moving higher as well, which further endangers inflation going higher in the coming months and affecting consumer spending as well. And it seems like everything's working today. Stocks, bonds, cryptos, commodities, with that nice move up in gold we haven't seen for a while. But for now, the market's still pinning its hopes of a rate cut come June, which if the Fed can pull off without anything major breaking in the economy, is more fuel for this rally. Cost of capital for consumers and businesses come down, relative attractiveness of stocks versus bonds go up. That's all really supportive of higher stock prices if the rate market can follow this trajectory lower this year. And that's what really kicked it off in late October, when Jay Powell pivoted from hawkish to dovish and has kept the stock market feeling greedy and extremely greedy for over 3 months now. But let's just keep in mind, corporate insiders are cashing in on this huge jaws gap continuing between the selling and purchasing that they are doing in this market. And just getting back into the charts, got a little bit of bounce from China today as well. Clean energy looking to find support here, and a good Friday session for international stock indices. Canada's TSX ripping up to a new yearly high. FTSE shaping up. German DAX looks to be walking the line higher. China's 50 index looks to be in a solid short-term uptrend, and the best ripping international stock market continues to be Japan's Nikkei. It too has gone parabolic with a nice breakout on the Aussie 200 as well. And you can tell this market's feeling good by looking at the spread between high beta stocks and low volatility, shaping up to break out to highs. And the spread between consumer discretionary versus consumer staples still holding on to this solid uptrend, and gold starting to outperform treasuries again as the place to seek safety, as the IPO sector heating up and all the other leading sectors still doing well. Home builders, industrials all-time highs, and a sector not many people talk about, aerospace and defense, currently trading at all-time highs as well. Nice big move up in junior gold miners today. Strong rip on volume there. And there we are with Apple. Like I said yesterday, looked like we were going to fall through the support, and we had quite a dip there today on an otherwise bullish day across the market, getting down to 177. Did manage to reclaim some lost ground in the afternoon, but that's lower highs, lower lows. Apple looks to be in a short-term downtrend. Microsoft still holding up a lot better, along with Amazon, and continued move higher in Meta. With Tesla still holding in there and still getting some wild moves in these meme stocks. Big Bear, Eastman Kodak, Carvana, and the other hot stocks we're watching. Even companies that sell chicken wings, trading on a price-to-earnings ratio of 149. Those wings are too expensive for me. And like I said, with that big drop in New York Community Bancorp, normally in any other type of market, that would probably spill over at least across the financial sector into the market. But apart from the few other regionals, the whole market doesn't seem to really care a whole bunch at all. Because like I said, maybe it can swallow up this whole commercial real estate problem without it having really any big material effect on the economy nor on investor sentiment. So there we are, guys, the first trading day of March. Off to a great start again. S&P closing at all-time highs. The parabolic grinding uptrend continues. Volatility is low. Market seems to be shrugging off higher oil, higher shipping costs, Middle East tensions, regional bank woes. Doesn't really matter. The momentum has got a hold of this thing, and it may actually move into a parabolic melt-up trend until we hit some sort of blow-off top. Till then, it's all fun and games, and there's nothing wrong with riding those waves higher. Thanks very much for tuning in to Click Capital Daily Market Review and hitting that like button. Please leave a comment with your thoughts. Other than that, have a relaxing weekend. See all you guys again Monday night. Cheers.